thought. So glad to have you on the show with us.
It's good to be back. Always happy to come on and talk Bitcoin treasuries.
Absolutely. So we know it's another week here, which also means there's been another strategy Bitcoin purchase announcement. It's sort of crazy to think, 5 years ago or a little over 5 years ago when they started this strategy, their initial purchase was roughly $250 million. Just this past week alone, they bought roughly the same amount. And, it's now considered a slow week for them. So I'm curious, as a previous head of Bitcoin strategy, how do you think strategies management sort of thinks through which ATM to tap for their weekly purchases? And for context, this week they sold roughly $257 million worth of MSTR stock and about $7 million worth of stretch. So it's roughly a 97.3% split. Just a few weeks ago, they had sold $100 million worth of stretch and about $1 billion worth of MSTR stock. So that's roughly 91.9%. And, they, of course, could use a number of other preferred securities that they have to ATM as well in any given week. So how do you think the management thinks about, this on a week-to-week basis? And what are the key factors to optimize ATM usage across their various securities?
Yeah, I would say probably the two main things they're looking at are volume and price. And stretch, for instance, if price isn't over $100, they're not going to ATM it. It's just as simple as that. But then once price goes over $100, they can they'll ATM it as much as they want to, provided that the volume is there, that they can do that without crushing the price. Because if they themselves drive it back below $100, well, then they're going to stop. For the other preferreds, it's a little bit different. Probably for Stride, for instance, there's going to be a reluctance to ATM that too much because it's still trading below par. So even if there were demand for it, you're selling $100 of liquidation preference for right now $76. So it's, for lack of, I don't know if most people call it too sweet of a deal, but it's, in a sense, it's too sweet of a deal. And for the other preferreds, I think also just really the focus right now is really in trying to push out stretch. We haven't seen the Strife or the Strike ATMs that active lately. They probably could be selling more, but I suspect that really they're just trying to focus on ramping stretch. It's where they've got the most traction, the most demand, and the best product market fit. The only really barrier to issuance is having that hard cutoff of price that they need to issue the new shares. As for the common ATM, likewise, I think it's mostly a factor of price and volume, and also, of course, MNAV. They're not going to ATM below 1x MNAV because that would make no sense. But MNAV can still be 1.08 but have very heavy volume, and you can sell into that without moving the price as much. So I think really the calculation is it accretive? What does the volume look like? Can we sell into this without moving the price too much? If volume is really low, then issuance will be lower. If volume is really high, there will be more issuance. And as MNAV ratchets up, then the whole operation becomes more accretive. But on the same token, if let's say they're trading at a 2x MNAV, but liquidity was very thin, trading volume was very thin, then they still wouldn't just want to smash the ATM because it would have a very negative effect on price.
Do you think for a trader, there's, not necessarily an edge, but room to sort of trade around how stretch moves? So let's say it's above $100, and as you kind of just laid out there, MSTR strategy would likely be ATMing at that point. So maybe that's when you'd want to sell or go short stretch as a trader. And then if it's below par, below the $100 mark, is there an opportunity to trade around that and buy it at that point, and then sell it back? Or is that sort of picking up pennies in front of a steamroller here?
Yeah, I think for traders, it depends who they are. I mean, there might be some people out there interested in collecting a very narrow but reliable spread. But for people looking for bigger 20-30% moves, you're never going to get that from Stretch unless you're levered beyond belief. So I would suspect that it is not attracting that much in the way of arbitrage traders. And it would be kind of bad for strategy if it was, because they would reduce their ability to issue the ATM. And also that, if rate goes, if the price goes below $100, and that arbitrage opportunity exists, I think that the people that it's really going to attract are people that are like they find the rate appealing. And so the price is somewhat self-healing in that way that, if it drops down to $90, suddenly you're looking at a much higher effective dividend rate, and that will attract more buyers into the market. It will attract people who are just buying it because the price is low and they expect it to close to par. But I suspect that the arbitrage trade overall is a much smaller piece of the pie.
Do you know if there are any funds right now that are, levering up to essentially just collect that 10% spread? It's fairly risk-free. And if not, if you don't know any funds that exist like this today, why do you think that's the case? And do you think we'll start to see that in the future? In terms of borrowing cheaply and then just putting it into Stretch?
Yeah, well, there are a lot of funds. There are a lot of different people building on top of Stretch, building algorithms around Stretch. It's not all out in the public eye, but I've had lots of conversations. There's lots of building going on, and I would say probably the most common thing is just margining against something to buy Stretch with. Taking the spread of 5% margin interest versus 11% dividends, you can collect a fairly risk-free 6%. That's a pretty common trade. Some funds stop there. Others employ more sophisticated algorithms on top of that. If you've got that 6% cash, you could do something, potentially do something else with that. Something else is that these preferred shares have options on them. And normally there's a little bit of risk associated with selling a covered call, but if you're selling a covered call on Stretch at $100, $100 strike, I don't know why anyone is buying those, but you can sell them and collect some additional premium on them. That's the buyer side of that trade makes absolutely no sense to me, but that's another way that people are squeezing a little bit of extra cash out of these.
That's a really interesting use case. And speaking of covered calls, would like to actually jump into MSTR covered call strategy and just all the volatility around MSTR, Bitcoin. Of course, there continues to be a lot of volatility in Bitcoin and therefore MSTR and other treasuries. I think the special thing about MSTR is that there's been reliable historical correlation with Bitcoin, and it also just has a very liquid options market as well. Which makes the strategy, viable if someone wanted to run that. But you've had some opinionated views on, whether this is good strategy, whether it's not. So I was hoping you could walk us through, from your view, the pros and cons to running an MSTR covered call strategy, especially in this mainly sideways chop that we've been seeing and sort of this bear flag formation that Bitcoin's chart has been signaling for a while now.
Yeah, I mean, covered calls are, the best strategy or work best in a downward moving market because because if the market's going down, then by definition you're collecting all the premium and you're not in a situation where your strike's getting blown out and you're getting shares called away. Of course, whether you come out overall ahead or not is a different story. If the market's moving sharply down, then you could still be losing money on paper. But I think that people don't hold a strategy because they think it's going down. They hold strategy because they think it's going to go up. And they hold strategy not only because they think it's going to go up, but because they think there are going to be these very short periods of outperformance where 2 or 3X's in the space of a couple weeks or even a couple days. And that's where holding covered calls can be potentially limiting. If you've sold a covered call at the money, and all of a sudden the strategy finally hits one of those periods where it's running, you've either got to panic roll it or you've got to just make peace with the fact that you've missed a lot of upside. And there's some downsides to it. You're taking a short vol position, betting against yourself, against one of the longest vol assets that markets have ever seen. So, it can be done. There are popular strategies. There's the 10 delta strategy, which is, let's say, lower risk than some of the other strategies. But there are other ways to do it. One trade I've been looking at that I find very interesting is a double short strategy, which seeks to monetize volatility drag from the 2x levered ETFs. And if you're familiar with the 2x levered ETFs, a lot of people mistake volatility drag for theta decay on options, but it's actually something very different. What volatility drag is let's say, strategy is just trading in range, just hypothetical numbers. It's going from $100 to $110, back to 100, just bouncing back and forth. This happens, say, a dozen times.
Yeah.
Strategy starts at $100, finishes at $100. But because of the way the levered ETFs work, they reset daily. So at the end of that period, even though strategy is back to its original $100, if you were buying, say, the levered long ETF, it's going to be worth less than it was to start with, just because of the way the math works out. The down moves are bigger than the up moves, so you're kind of like gradually losing value over time. And by shorting both the long, the 2x long ETF, and the inverse 2x ETF, you can isolate that volatility drag and monetize it. But it's not as easy as that, because if it was, everybody would do it and everybody would make money, right?
Yeah.
It'd be super easy. There are two challenges to it. One is that the borrow cost on them is quite high. And the other is that if you're in one of those periods where, say, strategy is moving straight up or straight down, the winning half of that 2x lever trade will blow out the other half. So it has to be hedged. So this is not a trade that I would recommend anyone try. It takes some very specialized hedging, and but that's.
What does that look like if you're able to share a little bit more? Like, how do you calibrate it in such a way that it actually does make sense and you are properly hedged and don't get blown out if either moves against you?
It's something that you really have to. I hesitate to even talk about it too much, because it really takes basically a proprietary algorithm. So I'm not going to share too many details of it. It really takes a proprietary algorithm to arrive at the correct hedging. So it's a trade that I really like, but one that I really can't recommend that the average person go out and try and do, because it really takes some specialized hedging. It's not something you can do just by looking through the options and picking the right thing. It takes some pretty sophisticated algorithms to arrive at.
Yeah, that makes sense. And like you mentioned, MSTR, one of the highest vol equities that the market has seen. With that, maybe on these covered calls on a weekly basis, one could earn 3%, let's say. Not saying this could happen consistently. And then, as you mentioned, there's the risk, potential opportunity cost of MSTR just making a sharp move, and then you missing out on that massive gain. Also the psychological worry that might come with that as well if it moves up against you. But that 3% is nothing to scoff at, right? And so I'm wondering, for you, I think you still sort of look at that as like, still trying to pick up pennies relative to where MicroStrategy might move over the medium to long term. But is there a sort of is there a return that would make selling the covered calls more interesting to you? Let's say it's 5%, 6%. Is there a level that would make more sense to you?
Yeah, it's not. I think it's not a simple answer. I mean, really, there's two different ways to slice this. If you want to increase the yield, basically means you have to sell closer to the money, and the closer to the money that you sell, the more at risk you are. So one of the unique things about strategy is that historically vol has been high enough that you could sell, something fairly out of the money. You could sell something like a 10 delta call and still get, a meaningful, say, 1 or 2% per month. But on the same token, if it adds a lot of stress. Anyone who's ever sold covered calls knows that once the price starts running, you feel it. So um, that's why in general, I shy away from doing it myself. And it's the type of thing where, if you're trading full time, you have the time to watch it and manage it. That's great.
Mhm.
But if you're just an average person who is getting up and going to work and maybe has a week where you really can't pay attention to markets, it's going to be that week where your trade gets screwed. So,
Always is.
yeah. So, for the average person, I'm always hesitant to recommend options. Um, but I think there is a place for it. There are tons of dedicated shops. We've got entire teams of people built around running covered call strategies. Um, and I think, in that type of a setup, if I was having a professional shop manage it, that I could outsource it to them, and they've got their eye on the ball 24/7. If someone's sick, there's like 5 other guys watching it.
Mhm.
That's a scenario where I feel a little bit more confident about it. Um, I could sell my own covered calls if I wanted to, but it's typically not something I engage in.
Right. And that's because Brian, you're focused on MSTR's long-term thesis and definitely wanted to get there. So what is it? Can you break it down for us? Because I think there's still a lot of people who forget, what's really going on here, especially as Bitcoin, starts to drop. And, it's almost exhausting at times and comical when you turn on CNBC or, maybe even on X and you hear MSTR is going to go out of business and Sailor might have to do this or that, and the strategy isn't working. And we all know, of course, when Bitcoin does bounce back, MSTR inevitably follows. Case in point, over the past few weeks, we saw Bitcoin rally back to 95K or so. MSTR moved right up with it, and down as well with the extra volatility as expected. So I know that you've talked about the long-term thesis. Really with around 2 points on X. You're pretty good at breaking things down from first principles. For example, your Bitcoin strategy, it's just super simple. Keep DCAing, and that's been correct. So can you walk us through the long-term thesis and remind us what it is for MSTR that makes you just think selling covered calls not attractive at all?
Well, yeah, I mean, so just to address the thesis part, I think it's pretty simple. If you think Bitcoin is going to have high performance, strategy benchmarks against, a 30% CAGR over the next 10 to 20 years, if you think that is what is going to happen, then you can very comfortably borrow money at 10%. Typically, preferreds aren't borrowing money; they're equity, they're not debt. But for the sake of simplicity, you can pay 10% interest or dividend, depending on how you look at it, to buy something that appreciates at 30%, and then you've got a 20% spread to collect. If in your mind that is a good bet, then that you know that is a very profitable trade. So that essentially is what the thesis is. Just is the rate of appreciation of Bitcoin going to outpace the cost of financing? And it's very, very simple. There are a couple nuances that don't materially impact the thesis, but of nonetheless are things to consider. That 10% hurdle rate is theoretical, depending on, let's say, if you bought Bitcoin and you actually had to sell 10% of it per year. If you think about it, like if I had to sell 10% of my Bitcoin holdings per year, then it has to appreciate by at least more than that for the dollar value to be increasing over time. But the strategy is not selling the Bitcoin. They don't have to sell the Bitcoin. They're selling shares. So actually, they are keeping all of the Bitcoin as time goes by. So they're getting the compounding value of Bitcoin, and what they're selling is shares. So there are some dynamics, like does the if they go out and they sell an extra $1 million worth of shares, does the price bounce back to reflect the net asset value of the shares? There are some arguments about that, but nonetheless, it is still an advantage that they can issue shares and not have to sell Bitcoin to pay for these dividends, because it allows them to take full advantage of the compounding of Bitcoin Whereas on the liability side, that 10% dividend is not compounding. If they sell $1 million worth of dividend or of preferred shares and they have to pay $100,000 worth of dividends, it's the same $100,000 every year. It doesn't compound. So, on the one hand, you've got a compounding asset. On the other hand, you've got a non-compounding liability. That's very powerful over time, as long as you're right about Bitcoin appreciation.
And you've been one of the, I would say, few MSTR Bitcoin bulls on X to also talk about, what the potential risk might be to both Bitcoin long-term and, as a result to MSTR. So can you highlight those as well?
Yeah, some of the risks, I think the risks are typically misidentified. Maybe to start with some of the things that the risks aren't. Bitcoin getting down to strategy's average purchase price has absolutely no meaning whatsoever.
Peter Schiff keeps calling that one out, and he'll comment on if Sailor will announce, hey, we bought this much Bitcoin, and Peter Schiff, I was reading it last night, he's commenting, your average price is it's at this, and it's almost reaching Bitcoin's value today, and it's just okay.
Yeah, well, I think a lot of people, they think that this is secured debt, and he's going to get liquidated if it gets down to his purchase price, and it's just totally not the case at all. It's just not how this works. The debt that he does have, the convertible bonds, is unsecured debt. So there's no liquidation price. There's no, they're not callable. They mature at some point. Preferred shares are equity, perpetual equity, which never matures. He's only on the hook for dividends. So it's just that number, that average purchase price number is just meaningless. Also, some people, they call out the leverage, which he's just not that levered. His target, we used to call it leverage, now we call it amplification, because technically the preferred shares, they don't count as leverage because they're equity, not debt. Mm-hmm. But amplification is the same idea, just factoring in the preferred shares. The target range on that is 20 to 30%, which just isn't that much. You figure, Bitcoin has to have a 70 to 80% drawdown in order for him to be insolvent on paper. Could it happen? Yeah, it could happen, but it would have to persist. It couldn't just be a one-time thing. We have a bad year. It would have to go down and stay down for multiple years. Even the dividends now, he's got a 2+ year runway on paying dividends for the existing preferred shares. So the balance sheet, the cash position is very rock solid right now. But to get back to risks, that is the risk, that it goes down and it stays down for a long time. So what could actually cause that to happen? One would be if Bitcoin gets quantum hacked or something, which I put very little stock in. I think quantum FUD is way overblown. The most realistic scenario to me would be something like if we have a lost decade in equities, and despite what people try to sell Bitcoin as an inflation hedge, but it doesn't behave like one. It doesn't track gold and silver. It most closely correlates with NASDAQ. So if we have lost decade in equities, where NASDAQ is down, 5-10 years, goes nowhere, and Bitcoin follows that, it goes nowhere for 5 to 10 years. Meanwhile, there are stacked dividend liabilities that have to be paid out over that time frame. That's potentially when the position starts to get uncomfortable. But he still wouldn't go bust because the Bitcoin stack is so large that it can be paid out for years and years and years. So it would take, I think, even more than that to actually make the company go bust. Of course, the shares would not perform well during that time frame if that's what was happening. Mm-hmm. But the company itself would not be at risk of going bust unless that situation where Bitcoin is down, it stays down, it doesn't come back. It keeps going on for perhaps longer than a 5 to 10 year period. 15 years out, if Bitcoin is still at 80K, yeah, Sailor's in big trouble. But nobody who believes in Bitcoin thinks that that's what is going to happen. If you're Peter Schiff, you think it's going to zero immediately, but he's been wrong for 15 years. So I'm just going to ignore him.
15 years straight. Wow, that is something. But yeah, so I mean, you mentioned something very interesting there about Bitcoin trading with equities, and a lot of people talk about the debasement trade, de-dollarization. That's happening now. We're seeing gold, silver, other precious metals just continue to soar, to skyrocket, and kind of trade like you would expect. Bitcoin and maybe some other cryptocurrencies to trade, but Bitcoin has not done that. So I'm curious, why do you think Bitcoin has been left behind? And maybe it just goes back to what you were saying about it trading more in line with equities. But I think at the same time we can't ignore the fact, one important factor of Bitcoin, which is its absolute scarcity. So you would think as the debasement trade is happening, as the dollar continues to lose its value, that we would see Bitcoin sort of having a similar run up to gold and silver, but that hasn't been the case. So, could you help break that down for us?
Yeah, there are probably many different things happening here. One of the probably more, let's say, plausible theories that I've been reading about is that the effect on gold and silver versus Bitcoin depends on where liquidity injection is coming from. If the liquidity injection is coming from China, then that money tends to get funneled into gold and silver for various reasons. If the liquidity injection comes from the Fed, then it has a higher chance of going into Bitcoin, and that has been more or less what we've seen over the past, say, year and change. The prices being driven higher in gold and silver has been very China centric. Of course, it's been driven higher elsewhere, but the spot markets in China are consistently a few points higher, sometimes up to 10 to 15 points higher than elsewhere in the world, and that's where a lot of that spot buying has been driven. And that I think is some evidence in support of the theory that if liquidity is being driven by China, then it's going to go into gold and silver. If liquidity from the U.S., which has been fairly tight, if that's where it comes from, then it could go into Bitcoin. So if things change here in the next few months, if we get a new Fed chair, if we get more easing, if we get looser conditions in the United States, then perhaps we start seeing that capital rotation into Bitcoin. And capital rotation might not be the right word because it implies the people who are buying gold and silver switch over to Bitcoin, when in fact it could be the case that the marginal buyer of these is very different. But then momentum chasers, once the tides shift, I think would shift into Bitcoin if that's where the attention was going.
Yeah, it's a very good nuanced point there, because oftentimes you'll hear people say, "Okay, we just need more liquidity in the system, and that's going to, drive Bitcoin's price up." But I think you're pointing out here that it matters where that liquidity is coming from, and often we don't hear people talk about that. So I think really good point to take note of there. I was also looking at this morning. I think you wrote a little bit about this on X as well, as you've been looking at these precious metals. But gold is at 35 trillion, silver's at roughly 6 trillion. I think us Bitcoiners, we believe that Bitcoin is a lot better than gold. It's digital gold. It should at least be valued on par with gold at some point in the future, if not be valued more than gold, since we think it's better than gold. And so if Bitcoin had its current valuation today, let's even just call it 2 trillion, to get to gold's valuation be something like a 17x. And so Bitcoin's price would essentially would be, if it was valued at gold today, it'd essentially be $1.8 million per Bitcoin. I think you had a post about this where you talked about the Bitcoin case to 1 million. So that's essentially that. And since gold has went up so much, it'd be even greater. And then for Bitcoin to get to 10 million, I think you talked about how it would have to essentially be as big as the US dollar. Was hoping you could highlight or just discuss this a little bit more, and detail your thoughts there. And then also whether you do see it catching up to gold in the future and hitting that 1 million, $2 million mark. And how much are you factoring how much are you taking into account how much gold could continue to run up from here as well?
Yeah, well, I think people throw out, I think Bitcoin's going $1 million, or Bitcoin's going to $10 million, or $100 million. To take a step back from that and say what would have to happen for those numbers to be plausible. And for a long time, about $1 million was Bitcoin gold parity, but that has changed substantially recently because gold has run up so much. As you mentioned, it's now closer to $1.8 million. But yeah, I think it's it's important to consider. Okay, if Bitcoin were going to go to prices, Bitcoin, gold parity prices, then think about how many people in the world hold gold, the size they hold gold in, who holds the gold. How do we get Bitcoin holdings that reflect those types of allocations? What kind of players would have to come to the market? What kind of sizes would they have to be buying? And people say, "Oh, but Bitcoin's a fixed asset." Okay, yeah, that's fine. Um, you know, Gold supply is increasing, but if you look at the overall market cap, that kind of adjusts for these things, and gold is not it's not inflating that rapidly. I mean, say like 2% per year, I think is a typically cited figure. So yeah, that's about the size you need. Think about the gold market today. How does the Bitcoin holder base get to look something like that? That's the path that has to take place for Bitcoin to get to that size. Now, if you want to talk about a $10 million Bitcoin, which really here I'm just thinking about an order of magnitude larger than that. How does Bitcoin to be not just the same size as gold? How does it get to be an order of magnitude larger than that? And I think the real answer there is it has to penetrate much more deeply into the financial system. People have to be holding it probably something like treasuries right now. Yeah, and what I put in the post is I said it has to be as ubiquitous as the dollar. And I think a lot of people just thought about, okay, well, M2, but M2 is actually not that big. But the dollar is more than just M2. It's it's the euro dollar, it's treasuries, it's all these things that underpin the global financial system. It's and especially that collateral piece where treasuries are used as collateral, um, you know, all over the place for repo loans and reverse repo loans. Also, if you're a large holder of dollars, so you have $10 million in the bank, you're not holding $10 million of cash. You probably have most of that in treasuries. So it's important to consider the whole gestalt of the dollar, so to speak. And I think probably that for Bitcoin to get to a $20 million price, which would be $210 trillion market cap. It's going to have to be something on the order of that magnitude. It might not look exactly like the dollar. We might not be seeing prices in the stores everywhere priced in sats, and it might not be the everyday currency of exchange. But it's going to have to be pretty big. It's going to have to rival something much more than gold in terms of distribution and ownership and penetration into the financial system in order for that figure to be viable. So I think that when you think about long-term future of Bitcoin, you really have to think, do you believe this is going to be an integral part of the future global financial system? Not just do I think it's going to be worth a lot of money, but are the conditions required for those prices to be achieved? What are those, and is it plausible that they're going to be met? A lot of people think the answer to all these questions is yes. So I tend to be the camp that I think it can get there someday. If I didn't, I wouldn't be in Bitcoin. I think that's this is the goal that is being pushed for. But it's important to realize that, not just be like, yeah, it's going to go to $10 million just because.
Yeah, it's how does it get there? What conditions need to be in place? And speaking of the global system here, would like to move over to Japan and more of the international market. So we all know it's a very interesting time for yields in Japan. Japanese 10-year continues to climb above 2%, is the highest level in over 25 years. You've said the most interesting story in Bitcoin treasury company land in 2026 might be Metaplanet's preferreds. Can you share more about this as it relates to what's happening in Japan with the 10-year right now?
Well, the story in Japan has been all about, at least the story for a Bitcoin treasury company in Japan has been all about this low rate environment, and so that's one of the main reasons that attracted me to Metaplanet as a company was that the one they were micro cap, now they're a small cap, but beyond just being a small growth company, they had a very attractive market. They're at the epicenter of the yen carry trade, and it's a major force in global finance, and it's all been powered by these structurally low rates in Japan, where the Bank of Japan has been holding rates low for decades, and they're starting to lose control of that. It's happening more at the higher end of the yield curve. I think especially if they wind up raising most of their capital or targeting the lower end of the yield curve, such as their Mars product, which is basically designed to be sort of like a stretch clone. That's really the end of the yield curve to pay attention to, more so than the 10-year or the ultra long 30-40 year. And the spread between U.S. interest rates and Japanese interest rates is still much wider on the short end of the curve. I think those like I said, I think those more so than the longer rates are the ones to pay attention to, because that's where presumably the capital would be raised. But yeah, if those spreads do continue to collapse, then Metaplanet becomes much less interesting, because the advantage of lower rates, which is what was interesting to begin with, begins to disappear. But I don't think we're there yet. Japan cannot afford high interest rates. Just as soon as those rates started to blow out, we saw intervention from the Bank of Japan, and I'm sure they will hold rates down for as long as they can, which could, for all practical purposes, be the investable time frame for any person thinking about Metaplanet.
Okay, and I think
Not financial advice.
yeah, I think Saylor has most recently mentioned that he and Strategy would not be entering the Japanese market, but by the same token, I believe at some point he did hint that they might. Right, he told Metaplanet he would give them a head start. He is in the past has said things about the company that he's walked back, which he of course reserves the right to do if the facts change. He can change his view and perspective on what the company should do. But not just taking Saylor's word for it, what incentives what do you think the incentive actually point to in terms of whether Strategy will be entering Japan in the future, and perhaps other markets like the UK and Brazil?
Yeah, so he mentioned those three markets specifically, UK, Japan, and Brazil, as ones he would not enter. And I think there are reasons actually to believe that will be the case. And explain why here. So, in Japan, and this is one of the things that I brought up from the very beginning that no one wanted to hear me out on, was that there are major advantages to being a local issuer in Japan, and those are very much coming to play, and why Metaplanet will likely get their preferreds off the ground, and Strategy will never enter the Japanese market. The big factor is that in order to list preferreds, you basically have to prove you can pay for them. Japan has what is called sure I'm calling it the right thing, the likelihood of profit rule. The likelihood of profit rule. So there needs to be, for the Tokyo Stock Exchange to allow these to be listed, there needs to be at least a reasonable expectation that the company could earn sufficient income in order to pay for them. And that is not the case for Strategy, and is not likely to be the case for Strategy anytime in the near future. Now, there are further complications that even Metaplanet, they pass this viability test with the Bitcoin income generation that they're doing, primarily through derivatives trading, but also could conceivably be in a situation where they're not actually allowed to pay dividends from their net operating income. And so there are these two different buckets of cash. There's retained earnings, and then there's this other bucket called, again, make sure I'm calling it the right thing, other capital surplus. So these are the two different buckets. And if they sell shares to their moving strike warrants or through their preferreds or some other program, that goes into the other capital surplus bucket, and they can take money out of that to pay the dividends with. But there's also this rule where once a year they can retag, relabel, reclassify capital from the income side over to that other capital surplus bucket. So that basically gives them a once a year chance to move money from the derivatives trading income over to that other capital surplus bucket, which would allow them to pay dividends from that. And this is a very Japanese specific accounting, very Japanese specific regulations. Strategy will never do this because they would have to restructure their business in such a way that one is completely unnecessary for the US market and has a lot of complication that would just make no sense for them. So I don't see them ever entering the Japanese market ever, unless Japan significantly changes its regulations, which I don't see happening. So I think that most likely Metaplanet, it's their playing field. They've got the home team advantage. Their business is being custom tailored for this scenario. They've been working on it for a couple of years. So long as they're able to monopolize the markets and also take advantage of low rates there, I think it's a very interesting value proposition.
Gotcha. And for other markets, international markets where it does make sense for strategy to enter from a regulatory perspective, is there something besides the interest rate on the preferreds that they could compete on with the home players within those markets? And if not, does it make sense then for there to be multiple companies, treasury companies in the same international market if they're just competing on interest rates?
Well, from the perspective of the preferred share buyers, I think it really is just the rates. The rates are the main thing, and at least some reasonable expectation that the company will stay solvent. But there are some other wrinkles, and I think it makes sense to talk about why they won't be entering the UK, why they won't be entering Brazil, to just get us a look at what the overall pattern is and what the challenge is. In the UK market, the situation also kind of comes back down to this operating income issue that in the eyes of the Financial Conduct Authority, I believe that's what it stands for, the FCA in the UK, strategy is not a software business. They are a levered Bitcoin ETF. But other companies like Smarter Web Company, they are still viewed as a web services business. And in order for them to be able to viably operate in the UK market, they have to maintain that status. And which poses a challenge because as the Bitcoin balance sheet grows, they need to grow the web business in tandem with that. And they've announced plans for acquiring other web services businesses to keep scaling the core business alongside that. Which personally, I think will be very challenging. That requires a lot of M&A. It requires actually managing and running those other businesses, which, it's a challenge. But that's obviously something strategy would not be able to do. The software business has been left in the dust in terms of its relative weighting within the valuation of the company. And then, in Brazil, there are reasons why they won't be entering there either. For one, the Novo Mercado, which is Brazil's premium listing segment, does not even allow preferred shares. So if they were to list preferred shares in Brazil, they would have to do it on a lower market tier, which wouldn't have as good volume and reach, and et cetera. And there's another very negative factor to operating in Brazil, which is that it requires public companies to pay out 25% of net income as dividends every year.
Whoa.
Yeah, it's a major negative. Imagine, strategy reports, if they have a paper gain in Bitcoin, that's counted as net income. So imagine if they had to pay out 25% of that as a dividend. Major no. So
got it.
Yeah, when Saylor says he won't be entering these markets, I think there are very good reasons why, and why he will not enter them or change his mind later.
Got it. No, that was an excellent breakdown, Brian. Appreciate that. And as we close here, it's a very interesting week. I mean, we have the Fed decision tomorrow. Rates are expected to be unchanged. We also have a potential government shutdown this week. So lots of things going on. More tariff threats have happened over the past few weeks and kind of just popping up randomly. So expecting a lot of volatility with everything that's going on as we close January here, and with these different events. What are kind of the main things you're looking for and watching as it relates to Bitcoin, MSTR, and things that you're thinking about as you're positioning yourself for the rest of the year for 2026?
So, broadly speaking, I pulled most of my capital back into U.S. markets because the more I dig, just as we discussed, the more I dig into these other markets, the hurdles to running a Bitcoin treasury company there are just in general much higher. Even for strategy to list in Europe, they had to go to the Luxembourg exchange, which does not have the same type of market coverage as an exchange like Euronext. And part of that has to deal with just more regulatory hurdles with how they're able to list these, how they're able to sell them. Really, I've personally, with the exception of Metaplanet, I've mostly refocused my interest back stateside. And really, what I'm looking for is that U.S. liquidity going to get going? I think really we're in a holding pattern in the U.S. until we get a new Fed chair. Trump a few weeks ago announced he was trying to round up his buddies and have them buy mortgage securities to try to drive rates down. And to me, that was an indication that any kind of easing from the Fed or any kind of broader stimulus wasn't going to be forthcoming anytime soon, or else he wouldn't have had to do that. I think really just we're probably in a holding pattern. We've also got midterms this year. Typically the first half of a midterm year is a bad year for risk assets. Short term, I'm bearish. Frankly, I'm bearish short term, but structurally bearish long term. And I think it's we just need to see the effects of U.S. liquidity ramping up. When you see that happen, we'd have time for that to trickle into the system. Whatever else Trump might do to try to juice markets this year, we need to see what that looks like. But basically, that's what I'm looking for. That's what I'm paying attention to. Mostly focused on what's happening in the United States right now, both in the Bitcoin treasury market and also on the government side with what's happening with liquidity.
Wonderful. Well, stay on your toes, everyone. Try to stay level-headed, even kill. And Brian, it's another great session here. Actually checking out some of the comments in the chat. We have love the channel. Someone's listening from Brooklyn. MSTR and BTC are going to leave quite a few people behind, and they're leaving the station in Q2. Okay, we will see. But Brian, thanks for all the insights to knowledge share as always. Really good session here. Really enjoyed this one.
Well, yeah, well, it's always great to be on the show, and hope everybody enjoyed what we had to say.
All right, guys.